Hello, everyone, and welcome to live virtual revisionary classes from the Board of Studies. Today, the topic that we have for the revisionary lecture is on transfer pricing and advance ruling. I am Kriti Chawla, and I shall be taking up this particular presentation and this particular lecture on the topic transfer pricing and advance ruling. Before we actually get started for today, I thought I'll talk to you about a few things for the entirety of the session today. First thing first, if you have any doubt relating to any topic that we discussed today, feel free to put in your doubts or put in your query on the chat box right here. Alternatively, what you can do is also put up your query on the chat box on the ICAI portal, and I will be looking at that particular portal also side by side. If at all, you could also unmute yourself and address your query, there. Now, as we go through this particular revisionary lecture, I'm okay if you actually address your doubts or if you put in your query right then and there when we're discussing a particular topic, or we can put in 15 minutes through the end of the session so as to discuss your queries through the entire topic that we have. So that's how we'll go about it. Now, because this is a revisionary lecture, what I've actually done is through all the topics that we'll discuss today, I have put in some questions from past papers right here. So for example, when we discuss this particular concept on associated entities, I have some questions from past papers right here. So through these particular questions, we can, just revise through the topics. Otherwise, what I've done is I've also put in a lot of examples. Now, these examples are coming in, most of the examples are coming in from the, module on transfer pricing itself. And that's how we'll conduct this particular revisionary lecture. Now, as far as this lecture is concerned, I have two topics that I have been allocated. The first one is transfer pricing, and the second one is advance ruling. As far as transfer pricing is concerned, sorry about that. Now, as far as transfer pricing is concerned, we shall start with an overview of transfer pricing. So this is where I'll tell you, very basic stuff like what was the need to have transfer pricing rules come into play, etc. Now, I do understand that this is a revisionary lecture, but I'm trying to build up the base for, also students who might have missed on this particular topic. So we'll discuss what was the need to have transfer pricing, and then we'll start with technical topics relating to what are associated entities, what are international transactions. We will also talk about, the selection of transfer pricing methods. So very quickly, I'll take you through all the transfer pricing methods, that are there. Then we'll discuss transfer pricing documentation. And after that, we will go into specific topics and dispute resolution topics, which are safe harbor rules. We'll go into APAs, which is advanced pricing agreements. We'll also discuss primary and secondary adjustments. And finally, thin capitalization rules, which are also called as limitation of interest deduction, Section 94B of the Income Tax Act. We will also be discussing, the topic on advance ruling. So for the purposes of advance ruling, again, we'll go through all the basic topics that are there in the module. And finally, we'll end it up with, some questions from past paper itself. So that's how I have, put in all the topics and try to cover very extensively all the topics that are there in the module itself. It's going to take a bit of time because, I think I have put in all the topics right here for revisionary purposes. I have not put in a selection here, but it's all the topics that are there in the module itself. So it's going to take a while. What we can do is, we can just take very small breaks after we finish. Maybe after 1 hour, we'll take very small breaks, and that's how we'll finish, all these extensive topics that we have for today. So without much delay, let's just get started with the topics that I have, for today. If there is any other topics that topic that you'd like me to cover that is not there, just feel free to put it in the chat box and I will try and cover it even today itself. So yes, let's get started for today. Okay. So the point is, what exactly is, transfer pricing? Anyone who can tell me why did transfer pricing come into place? Can you put it in the chat box? Why do you think, you can put it in a very short, word. What was the problem that transfer pricing came into place? It's something like tax, something, something. Can you tell me what was the problem why transfer pricing came into place? Okay, just to give you a little hint, do you think it was tax avoidance or tax evasion because of which tax transfer pricing came into place? Is it tax avoidance or is it tax evasion? Okay, so there are okay, so we have answers which basically say, um, okay, MNC fair price calculation, price charged more or less to associated enterprises to avoid taxation. Yes, that's absolutely correct. So what I'm really trying to say is that transfer pricing rules came into place because of something called as tax avoidance. And I keep posting things on the chat box as well, so you can have a look there. So transfer pricing came into place because there was a problem, and the problem was tax avoidance. It was not tax evasion. Can you tell me the difference between tax avoidance and tax evasion in this context here? And in very, very brief, can you tell me which one is illegal? Is it tax avoidance or is it tax evasion? Yes, that's absolutely correct. So when it comes to evasion, that's what is illegal, and tax avoidance is the use of loopholes. That's absolutely correct. So what happens is there are these two terms which are called as tax avoidance and tax evasion. When you talk about tax evasion, it's absolutely illegal. So if there is a multinational enterprise, for an example, which is conducting tax evasion, which is basically forging documents so as to minimize their tax liability, that is illegal. There is nothing right about it. There is imprisonment, or there is fine and penalty under the act for the purposes of tax evasion. But when it actually comes to tax avoidance, there was a time that it was called that there is everything legit about tax avoidance. There is nothing illegal about tax avoidance as such. But then there is a growing concern that tax avoidance is more like a crime against the society. It is again using these particular loopholes to pay or to minimize the tax liability in a legit manner. But then there is a growing concern of how tax avoidance is also like a crime against the society, and the multinational enterprises should pay their fair share of taxes. Now, the reason that I'm actually discussing the difference between tax avoidance and tax evasion is because transfer pricing came into place so as to make sure that tax avoidance strategies do not happen. Oh, I'm really sorry. The video is off. I didn't realize that. Okay, can you hear me? Can you see me now? Sorry,
Yes,
sorry,
ma'am.
sorry.
Yes,
Okay.
ma'am.
Okay. So what I'm really trying to say is that, the reason that they actually came up with tax avoidance, the reason that they came up with transfer pricing was because tax avoidance strategies do not happen. For tax evasion, I think it was pretty simple. There is imprisonment, there is fine penalties, as I mentioned. But then for tax avoidance, there was absolutely nothing, and multinational enterprises were not paying their fair share of, taxes. This is the reason something had to be done, and they came up with something called as transfer pricing rules. So if someone asks you, what about transfer pricing? Is it trying to target tax evasion or tax avoidance? Well, rightly so, it is trying to target tax avoidance strategies. We will be talking about this, more as we go forward, but it's very important because these are, there are some tricky questions that you can actually expect, and those were actually based on this particular topic of tax avoidance or tax evasion. So it's very important for you to know all this. Okay, so this is the slide that actually says that what was the problem, why they came up with the problem with these kind of transaction is something that we will be discussing today. Now, if there is a transaction between unrelated parties, or if there is a transaction between independent parties, What do I mean by independent parties? Well, parties that are not related to each other, some random two enterprises in, the market. If there is a transaction between them, this transaction is always driven by market forces. They will always transact at something called as, the fair or the open market price. What is the open market price? Well, it is the price which is determined by the mechanism of demand and supply out there. So, what they'll actually try to do is the buyer will always try to buy at the lowest price possible, and the seller will always try to sell at the highest price possible. And that's how, they negotiate and they come up to something called as an open market price. So transaction between independent parties is always happening at an open market price. But the transaction between associated enterprises is not really happening at open market price. What is it happening at? Well, the transaction between associated enterprises is always driven by a combination of market forces and something called as group driven factors. What are these group driven factors? Well, the relationship that exists between them. So, if there is a transaction between related parties, they will say that, listen, I'm not going to sell you at something called as open market price. I'll try to sell you at something which is very, very different. And what is this, different thing? Well, they'll try to, market the commodity at a price which will help them minimize the tax liability. So this is the reason there, happens something called as manipulation right here. They do not transact at an open market price, but they transact at a price which is driven by a relationship that exists between them, or some common interest that they have. And this is the reason they manipulate the price. And manipulating this particular price, this helps them to reduce their tax liability. And this is not reflective of economic reality. They reduce their tax liability, and the tax that a particular country or a particular jurisdiction gets will be actually much lesser right there. So let me explain this concept using this particular diagram right here to tell you what exactly happens with the with the manipulation of prices that happens between related parties. So in this particular diagram, we'll talk about two situations right here. There is situation one on the left side of your screen, and then there is situation two on the right side of your screen. So situation one talks about independent enterprises. It's very important for you to know that a transaction between independent parties, it is also called as an uncontrolled transaction. Just remember this, okay? This is called as an uncontrolled transaction. Can you tell me why is this called as uncontrolled transaction? Okay. Why is the transaction between independent enterprises also called as uncontrolled transaction? Okay, that's absolutely correct because there is no manipulation of price, right here. So that's absolutely correct. And the transaction between related parties, it is called as controlled transaction. This one is called as controlled transaction because, when you actually look at a transaction between related parties, it is always at the control of each other. The related parties, they try to control each other. And that's the reason, these are called as controlled transaction. And when it comes to independent enterprises, there is no manipulation of prices. There is no relationship between the buyer and the seller, and this is called as uncontrolled transaction. They are not controlled or they are not influenced by each other, and the price is also not controlled and influenced by the parties. This is the reason this is called as independent party transaction, which is also called as uncontrolled transaction. So when we look at situation one, which is the uncontrolled transaction, let's say that there is a company in India, which is, let's say, a manufacturer, and this particular manufacturer, let's say that manufacture, pencils. They are trying to manufacture pencils and selling it to an overseas company, obviously outside India. Now, the cost of manufacturing this particular pencil is, let's say, 60 units or 60, in terms of currency. The sale is for 120. This is how did they arrive at 120? Well, this is because there is demand and supply operational out here. This is the open market price right here. So they decide that I will sell the commodity to the overseas company for 120. So the profit comes to 60. And let's say that there is tax at the rate of 30%. So the tax on 60 rupees comes to 18 rupees in this particular situation. Now let's look at the same situation in terms of related parties. Now everything remains the same right here in the sense that the company is a company in India. This company in India is also a manufacturer. This manufacturer is also manufacturing pencils, and they are also selling it to an overseas subsidiary. Now, if this particular overseas company was in USA, this overseas subsidiary is also in USA. That's the level of similarity that I am trying to achieve right here, and there is a reason that I'm saying that this is the level of similarity. I will talk to you about that later on, but everything remains the same in two situation. The only difference in situation 2 is that now the party are related to each other. So this is a parent company in India, and it is related to this particular overseas subsidiary in USA. Now the cost remains the same at 60 rupees. Why does the cost remain the same? Because this is a third party cost. A third party cost will never move. If they are procuring raw materials from a third party, whether it is to this particular company in India, whether it is to this particular parent company, a related entity, etc., this 60 rupees will not move because this is a third party supplier. The third party supplier will say that I am indifferent whether I supply to this particular situation or I supply to this particular situation. This is the reason the cost of 60 rupees will not move. Now, the sales is happening at 80 rupees. Why is the sales happening at 80 rupees and not 120 rupees? Because in this particular situation, the sales price is manipulated. The sales price is driven by the relationship that exists between this parent company and its overseas subsidiary. Now, they could have also sold at 120, but then they said that 120 is the market price and we are related to each other. So we can, because we are related to each other, we can manipulate this particular price. We can sell at a price which is, or fix up the price which is at our whims and fancies. So this is the reason they decide to sell at at 80 rupees. Now the profit becomes 20 in this particular situation. So 80 less 60, the profit becomes 20. Tax at the rate of 30% makes it 6 rupees. Now, if you look at the two situations, the tax in situation 1 was 18, but then the tax in situation 2 actually becomes 6. So why is there a reduction in the tax liability? Because in situation 2, this was a related party situation where they tried to manipulate their price. And by, putting their sales amount, lowering their sales amount, or, transacting at a price which is less than the market price, they were able to bring their tax liability also lesser. They were able to minimize their tax liability also. And this is a classic case of tax avoidance strategy. This is where you see that, by mispricing or by manipulating the pricing, they were able to indulge in something called as a tax avoidance strategy. So this is really the problem that transfer pricing is, trying to address. Any questions here? Any questions? Otherwise, what I'm going to do is move to the next case study. Through this particular case study, also, I will try to explain what is really the problem. In this particular case study, if you realize, we just looked at the perspective of the Indian company. We did not look at the perspective from the perspective of the overseas company. But in this particular case study, we look at the perspective from both the situations. But before that, any questions? Any questions right here? Okay, so now we'll move to the next part or the next case study where we'll try to establish again what was the problem, why transfer pricing came into place. So for this particular case study, we have two companies right here. There is something called as company F. Company F is an Indian company. The tax rate in India is presumed to be 30%. Now, this particular company F has another company, which is company I. This company I is a Singapore company, and the tax rate in Singapore is 17%. Now, how the transaction really flows is that company F manufactures something. Company F manufactures and sells the commodity to company I in Singapore, and company I in Singapore sells the commodity to this particular third party customer. Saying it again, there is company F. Company F sells the commodity to company I. Company I sells the commodity through to a third party customer. Now we'll look at the black font first. If you see this particular black font right here. Now the black font basically means that the companies are not related to each other. So company F and company I are not related to each other. Now, what company F does, it actually manufactures a particular commodity. So the cost of manufacturing this particular commodity is, let's say, $1,200. Now, company F decides to sell this particular commodity to company I at $1,400. So the profit in India, or the profit which is made by company F, actually comes to $200. I've mentioned the profit here. If you see the right hand side of this particular slide, there is a table right here which talks about, the profit. So the profit is $200. The tax in India, as I mentioned, is 30%. So the tax comes to $60 right here. 30% of $200 makes it $60 in terms of tax. Now, the commodity is purchased by company I. Company F sells the commodity to company I. So the purchase which is done by company I is $1,400. There is a cost which is, sorry, thank you. There is a cost which is incurred by company I in Singapore itself, which is $100 right here. And company I decides to sell this particular commodity to this particular third party customer at $1,600. So saying this again, company F sold the commodity to company I. They sold it for $1,400. So this becomes the purchase price for company I, that is $1,400. Now, there was also some cost that the company I in Singapore had incurred. This was $100, in terms of their cost. Now, they had put in $100 of cost, and then they decided to sell the commodity at $1,600 to this third party customer. So what was the profit in Singapore? It was $100. 16 less 14 less 1, that makes it $100 of profit in Singapore. So I've put it here, $100 of profit in Singapore. Tax in Singapore is at the rate of 17%. So the tax comes to $17. So what is the total tax that has been paid by this company and this company put together? Well, it's about $77. How? $60 of tax that they've paid in India and $17 of tax in Singapore. That makes it $77. Red font basically means that now company F and company I, they are related to each other, or they are associated to each other. What happens if they are associated? Well, they decide that we're not going to be transacting at open market price. We'll transact at a price which is driven by group factors, which is driven by our relationship, which is called as $1,300. So everything remains the same. The commodity remains the same. The jurisdiction remains the same, which is in India and Singapore. Just the only difference is now that company F and company I, they are associated, or they are related to each other. So they again decide that company F is manufacturing the commodity. The cost of manufacture remains the same at $1,200. Why do you think $1,200 remains the same? It doesn't change. Now that company F and company I are associated to each other, why is $1,200 not changing? Okay, any idea? Yes, that's absolutely correct because this is the purchase from a third party, and a third party will never indulge into price manipulation that ways. So that's the reason this is at $1,200. Now the sale of commodity is not happening at $1,400; it is happening at $1,300. So the profit in India is $1,300 less $1,200, which is $100. So I've mentioned it here in red 100 dollars, and the tax in India at the rate of 30% makes it $30 right here. Now the commodity passes to Singapore. The purchase is at $1,300. The cost is again $100, which is made by the Singapore company. This is also a third party cost. It will not change. And finally, the Singapore company not change. Why will it not change? Because this is again a third party cost. A third party cost will not change. Why will a third party customer accept not a market price? They will obviously accept market price, and this is the reason $1,600 will not move. So they sold the commodity at $1,600. They purchased it for $1,300. They had incurred a cost of $100. So the profit in Singapore is $200. $200 at the rate of 17%, which is the tax, that makes it $34. So now if company F and company I are related to each other, the kind of tax that they're actually paying as a group is $30 in India, $34 in Singapore, which makes it $64. And if you compare the two situation, the kind of tax saving that they have actually done is about $13 right here. They were initially paying a tax of $77. Now they're paying a tax of $64. So this is the reason there is a group tax saving of $13 right here. And how was there more like a tax saving or more like a tax minimizing the tax liability? Why was it there? Because there was something called as mispricing, unjustified pricing. There was something called as incorrect pricing or a tax avoidance strategy in place. Because they were able to reduce their transfer price, which is when they're transferring goods from one country to another, they were able to manipulate this particular price from $1,400 to $1,300 dollars. There was a group tax saving of $13 right here. And this price manipulation was the reason that they actually came up to something called as transfer pricing. To make sure that this kind of situation does not happen, this is the reason that they came up with something called as transfer pricing. Now, apart from transfer pricing, you must have also heard about something called as BEPS, base erosion and profit shifting. Now, profit shifting was also one of the reasons that they actually came up with these particular, rules right here. What was profit shifting? They say profit shifting from high tax jurisdiction to low tax jurisdiction. And this is exactly that. So if you see, India was a high tax jurisdiction right here of 30%, and Singapore was a low tax jurisdiction. So what they've done is initially the profit in India was $200, but they've moved profit of $100 to Singapore, and now the profit in India is $100 and the profit in Singapore is $200. So what they've actually done is they've shifted $100 of profit from India, which is a high tax jurisdiction, and given it to Singapore, which is a low tax jurisdiction. And this exactly is something called as shifting of profits from high tax jurisdiction to low tax jurisdiction. How are they able to shift this particular profit? Through price manipulation right here. So this is shifting of profit of $100 of profit from high tax jurisdiction to low tax jurisdiction. And because of this also tax avoidance actually happens. And this is the reason, uh, uh, you know, they had to come up with some strategy to make sure that this kind of situation does not happen. Shifted high tax to low tax to avoid tax. Sorry, I could not get you. Um, so what they've done is they've, yes, in this case, what they've done is they've shifted, profits from high tax to low tax jurisdiction. And that's the reason they have avoided profits, avoided tax. They have avoided a tax of $1,300 right here. And that's basically part of something called as base erosion and profit shifting. So this is, a classic example of that. So what I'm really trying to say is that something had to be done so as to make sure that these tax avoidance strategies do not happen. And this is the reason they came up with something called as transfer pricing rules. So what are transfer pricing rules? Well, transfer pricing rules or transfer pricing is really part of tax, but it's not like a tax as such. It's not like, equalization levy at the rate of 2%, 6%, whatever, or it's not, it's not like corporate income tax, 22%, 25%, or it's not like, it's not like a tax percentage as such. It's basically an anti-tax avoidance law. It's basically a law right there. And this law basically prescribes that at what price should transaction between related parties happen. So, what I'm really trying to say is that in this particular situation, the related party transaction, it happened at $1,300. So this is the reason transfer pricing law came into place to tell related parties that if you transact, what is the price at which you should transact? Should you transact at 1,300? Should you transact at 1,400? Should you transact at 1,200? Should you transact at 1,500? What is the price at which related parties should transact? That is basically the transfer pricing law. If you remember, in this particular situation, the related parties, they transacted at 80 rupees. Where did 80 rupees come in from? Well, 80 rupees was, just a price which was dictated between related parties. They did not transact at open market price. They did not transact at, 120 rupees. They just transacted at 80 rupees. Where did 80 rupees come in from? I don't know. I mean, this was just how the related parties, decided, how the related parties fixed up their, price. So this is the reason they have come up with transfer pricing law. And when transfer pricing law will be applicable here, the law will actually tell these particular related parties at what price you should be transacting. So this is the reason it is a law to prescribe what is the transaction price between related parties. And this is the reason it's also called as anti-tax avoidance law. Anti-tax avoidance law in the sense that there was tax avoidance that was happening. So this is a law that came in to make sure that tax avoidance strategies should not happen. So if you look at the definition of transfer pricing, it's basically the general term for the pricing of cross-border intra-firm transaction between related parties. So what you need between related parties is that related parties when is transfer pricing applicable? Well, it says that transfer pricing is the general term for the pricing of cross-border intra-firm transaction between related parties. So there should be related party transaction. It should be cross-border in the sense that this is the transaction between India and this is the transaction between its overseas subsidiary right here. So this is, a cross-border transaction. And then it says that it should be a transaction which is intra-firm, as in the two parties should be related to each other. It should be within a particular multinational company right here. So when these particular situations are met, well, transfer pricing rules are applicable. Transfer pricing rules will be applicable in this particular situation, which is situation 2 right here. So the point is, what happens, if transfer pricing is applicable here? What do you think is the price at which they should transact? What is it called? What is the price at which related party transactions should happen? Can you tell me the name of the price? Yes, that's absolutely correct. It's called as the arm's length price. That's absolutely correct. Very easy question. But yes, that's basically called as the arm's length price. Now, what is the arm's length price? We're very very simply put, if there are independent enterprises, what is the price at which independent enterprises are transacting? That is basically called as the arm's length price. But very, very important thing, it should happen in comparable situations. That is basically in this particular situation, um, we can take 120 as the arm's length price because this is the price at which independent parties are transacting. This can be the arm's length price, and these parties should also transact at this particular price of 120 rupees and not 80 rupees. But at this, for that particular thing to happen, it should be between a comparable transaction. You should be able to compare these two, transactions for that to happen. Can you tell me the five factors basis which you can test for comparability? Five factors, and this is an important question. Five factors with which you can test comparability. How can you tell that this is the arm's length price? These two situations should be comparable. So, how will you test comparability? What are the factors with which you can test comparability? Okay, the first is, not asset capital liability. Nature of business, yes. But the first thing that you will actually look at is, okay, not international transaction. What is the first thing that you will look at? Well, the first thing that you will actually look at is the characteristics of product or services, the characteristics of property or services. Meaning to say that if you want to adopt this as the 120 as the arm's length price, you should make sure that these two situations are talking about the same product. So this particular situation is pencils, and this situation is also pencils. So the product has to be the same. Then only you can adopt 120 as the arm's length price. Guess a situation. Let's say that this is talking about pencils and this is talking about a pencil box. Now, obviously, the price will be different for a pencil and the price will be very different for a pencil box. So this is the reason you cannot compare the two situations. So for you to adopt 120 as the arm's length price in this particular situation also, you'll have to make sure that the product is the same that you're talking about. So that is the first place where you test for comparability. So the first is characteristics of property or services. If they're talking about a service transaction, it should also be the same. If they are talking about IT services, this should also be talking about IT services right here. Then the second thing is, you must have heard about something called as FAR analysis. Can you tell me what is FAR analysis? Can you tell me the full form of FAR analysis? Okay. Okay. So it's, guys, can you hear me? Okay, so it's basically functions, assets, and risk analysis, meaning to say that they should have the same level of functions also. So if we're talking about this particular company as a manufacturer, this particular company should also be a manufacturer. You cannot compare a manufacturer to a distributor right here. So that is one another thing that you need to compare. Then another thing that you need to compare is that the kind of risk that they're actually assuming is also the same. Then what you have to compare is business strategies. If this is like a well established company, then this should not be a startup company. You cannot compare a company which has been in existence for 50 years to a company which is basically a startup company. So that has to be the same as well. So these particular characteristics you have to keep in mind so as to make sure that these two situations are comparable. Then this is the reason the arm's length price basically talks about a price which is applied, or it is proposed to be applied in a transaction between persons other than associated enterprises in uncontrolled conditions. What are these uncontrolled conditions? Well, in making sure that these conditions are not related to each other. The parties are independent to each other, and this is happening in a comparable situation. They are transacting in a comparable situation. That's basically the arm's length price. Now, where is the arm's length price coming in from? Well, the arm's length price is basically an international consensus in transfer pricing. When I say that this is an international consensus in transfer pricing, it basically means to say that all the nations, if you see around the world, they are following something called as the arm's length price. Most of the nations around the world are following something called as the arm's length principle. This is just where the arm's length price has been derived from. This is making sure that transaction between related parties are also happening at a market value, at an open market price, just like how independent parties are transacting. So that is basically called as the arm's length principle. And this will just make sure that tax avoidance strategies are, replaced, and tax avoidance strategies are prevented, and profits are not shifted artificially, like they were actually shifting in this particular situation. So that's basically the arm's length principle. Now we'll talk about what is the structure of transfer pricing provisions in India. Can you tell me when were transfer pricing provisions in India introduced? When was transfer pricing introduced in India? Okay. When was transfer pricing introduced in India? Guesswork. Guesswork is also fine. Okay. 2010, no, a little beyond that. Well, transfer pricing provisions were introduced in India in the year 2001. So it was, the Finance Act of 2001 that introduced transfer pricing provisions in India. And the Finance Act of 2001 recognized that, if there are international transactions and they are happening between, related parties, they are happening at a manipulated price. They recognized they are subject to not the same forces between unrelated parties, and this is the reason they came up with Chapter 10. And Chapter 10 is called as Special Provisions Relating to Avoidance of Tax. So this is Chapter 10 of the Income Tax Act of 1961. It contains sections 92 to 92F. They are dedicated sections, to transfer pricing. There are also rules right here. So it is Rule 10A to Rule 10AE, which basically talks about the transfer pricing, rules that we have in India. We will be talking about the sections going forward, but you have to remember that this is Chapter 10 of, the Income Tax Act that talks about transfer pricing provisions. So my next question is, why do you think they call Chapter 10 as special provisions relating to avoidance of tax? Why did they not say Chapter 10 transfer pricing rules? Why is it called special provisions relating to avoidance of tax? Any idea? Any idea? Chapter 10, special rules relating to avoidance of tax. Have you heard of something called as GAR? Anyone who's heard about something called as GAR rules? General anti-avoidance rules. Okay, so if you talk about general anti-avoidance rules basically talk about that, if this is an impermissible avoidance agreement, it's going to be, disregarded by the tax authorities, and if a particular transaction has been undertaken with the primary objective of tax avoidance, that is basically general anti-avoidance rules. Now, if you talk about transfer pricing, these are again rules that have come up so as to make sure that tax avoidance strategies do not happen. But these are special rules. Okay, these are special provisions basically between related parties, and this is the reason this is called as special provisions relating to avoidance of tax. So this is the reason it's sorry, there are something called as general anti-avoidance rules, and then there are something called as special provisions or special anti-avoidance rules, which are basically called as SAR, and transfer pricing happens to be, the SAR out here. This is the reason chapter 10 is called as special provisions relating to avoidance of tax. Any tax avoidance strategy that happens between related parties, that is what is attracted by chapter 10. Now, if you look at chapter 10, these are the relevant provisions. All these terms is what we will be discussing in detail going forward. So we'll start with section 92. Then we'll go on to section 92A, which talks about AEs. Then 92B, that talks about international transactions. We'll talk about specified domestic transactions, how to compute the arm's length price using all those methods. We'll talk about documentation, and finally, a lot of things like safe harbor rules, APAs, etc. There's a question on the chat tab. Both GAR and SAR are applicable. Well, this is, more like open to debate. What happens if there is a situation where SAR and GAR are both applicable? Do you think one overrides the other, etc.? Well, this is something which is open to debate, and you should, you could be interested in reading a lot of text which is available on the internet for that. Well, if you look at, how GAR rules basically start. It basically starts by saying that notwithstanding anything else contained in the Act. And section 92, which is chapter 10, that is contained in the Act as well. So, you can say that GAR overrides SAR, but then SAR is more like special rules, specific over general kind of situation. So this is the reason that there is a lot of debate on this particular topic, on the interplay between GAR and SAR. This is the relevant rules which we'll be talking about. There are rules for determination of the arm's length price, and there is something called as the most appropriate method. We'll be talking about documentation rules, and finally, the accountant's report as well. So we'll start with the first section, which is section 92, which talks about the application of the arm's length principle. So this is where section 92 of India's Income Tax Act 1961, it says any income which is arising from an international transaction, it shall be computed with respect to the arm's length price. So what I'm really trying to say is that even in case of India, India accepts something called as the arm's length price for the purposes of related party transactions. Now, this particular section also says that transfer pricing provisions will not be applicable if the substitution of ALP, if you're using ALP, and by using ALP, it reduces the income which is chargeable to tax, or it increases, the loss right there. So let's say that initially the income was 100 rupees, but then the transfer pricing officer used ALP, and by using ALP, the income came to, let's say, 90 rupees. So this particular situation, transfer pricing rules will not be applicable. Why? Because transfer pricing rules should not have the effect of reducing the income or increasing the loss of, the taxpayer. So that's the reason, if there is reduction in taxable profits, or there is reduction of taxes, paid by the Indian taxpayer, then transfer pricing rules will not be applicable, because the objective is to protect the tax base of India. This is where sorry, any questions before we get started with technical topics right here? Any question right here? Guys, I can paste down if you think that, it's too slow or it's too fast. I can just, paste down. Do you think it's too slow or too fast? Do you think the pace is too fast? Okay. Okay, great. Okay, thank you so much. Okay, so now we'll start with section 92A, which talks about the meaning of the term associated enterprises. Now, all this while we were, discussing that if two entities are related to each other, they should transact at ALP or, the arm's length price. The point is, what happens that the two enterprises become associated to each other? What makes the two enterprises associated to each other? Well, these particular criterias are provided in section 92A. Now, how Section 92A is drafted is that, there is Section 92A, there is subsection 1, and then there is subsection 2. When you read through subsection 1, it talks about, some generic things out here. It is like the general definition to make the two enterprises related to each other. And then you talk about subsection 2. If you have the act open, right here, you can see that there is a subsection 1 and then there is a subsection 2. Now, if you see subsection 2, that is where they have provided 13 instances right here. And the act says that if you fall under, or the law says that if you fall under any of those 13 instances, then the two enterprises will become associated to each other. So we'll start with subsection 1. And this is where they talk about the general, definition right here. It says that if there is any participation in management, control, and capital of the other enterprise, then two enterprises will be related to each other. As an example, this is what they're talking about. They say that if there is a company A, and the company A participates in the management, control, and capital of company B, well, then company A and company B will be associated to each other. Now, you might ask, what is the meaning of management, control, and capital? Well, these particular terms, management, control, and capital, they have not been defined for the purposes of Income Tax Act. They have not been defined for the purposes of transfer pricing law. So what they do is, you can, look at judicial decisions out there. What they've actually done is they've relied on other law, right here. So for control, or, for capital, they have relied on SEBI rules. Then, they have relied on other laws for the purposes of establishing what is the meaning of management, control, and capital. But the point is that there is no definition out here, and that actually makes it, subject to litigation also. So that for now, and we'll talk about this later also, but then for the purposes of section 92A subsection 1, there is no definition of management, control, and capital. But the law basically says that if company A somehow participates in the management, control, and capital of company B, well, then these two will be associated to each other and transfer pricing rules will be applicable. Even company A through an intermediary, if it participates in the management, control, and capital of company B, well, then also company A and company B will be associated to each other. Then they also talk about, the same person right here. If there is one person and this one person participates in the management, control, and capital of company 1, and this same person participates in the management, control, and capital of company 2, well, then company 1 and company 2, they will be associated to each other. So these are the criteria with which they are actually associated. And as I mentioned, this is just like a general definition that has been, provided right here. Apart from these, also, they say that there is relationship of mutual interest, etc., but nothing has been prescribed as yet. This is only the general definition that has been, provided, right here. But then, as I mentioned, that there is also something called as subsection 2. Now, subsection 2 has some very, very specific instances right here. And subsection 2 says that for the purposes of subsection 1, to, define these generic instances, they have provided some 13 instances right here. And they say that if two entities, they happen to fall under any of those 13 instances, then the two enterprises will be deemed to be associated enterprises. So what I've done is, now in these particular slides right here, like this slide, and this slide, I have mentioned these 13 instances, and we will be talking about these 13 instances in a lot of detail. But what I've done is I've divided these 13 instances into 3 parts right here. There are 13, some are called as capital conditions, some are called as management decision conditions, and some are control conditions. Now, this is just to make sure, or just to make it easier for you guys, that I have actually divided these 13 instances into 3 parts. But I'd just like to mention that the law has not done that. If you read through the law, they have just provided these 13 instances, but it's, just easier to remember. And this is the reason I have divided these 13 instances into these 3 parts right here. So let's start with the first few instances, the first 4 instances, which are also called as capital instances. So we'll start with the first one, which is section 92A, subsection 2. This is clause A. Clause A basically says that if there is direct or indirect holding of shares carrying 26% or more voting power, meaning to say that if one enterprise participates in the other enterprise and one enterprise holds 26% or more share capital of the other enterprise, then the two enterprises will be associated to each other. My first question is, at 28%, they will be associated. I'll answer it, sorry. Yes, they will be associated. If they hold 28% share capital, yes, they will be associated. At 26%, do you think they will be associated? If one enterprise holds 26% share capital in the other enterprise, do you think they will be associated? Yes, yes, they will be associated because the law says 26% or more. What if one enterprise holds preference share capital 29% in the other enterprise? Do you think they will be associated? 29% preference share capital. No, they will not be associated. Why? Because they are talking about voting power right here. And holding preference shares does not come with voting power. So this is the reason they will not, be associated right here. That's absolutely correct. With voting power is, what they're actually saying. So I have provided an example right here. Let's say that there is A Limited. A Limited is holding 33% share capital in B Limited. Well, they will be associated to each other. Then it says B Limited is holding 80% share capital in C Limited. So yes, they will be associated also. But do you think A will be associated to C? A is associated to B, B is associated to C. Do you think A will be associated to C? Yes, that's absolutely correct. They will also be associated. How will these be associated? Well, they will be associated through indirect participation. The law also says indirect holding of share capital. So if A is associated to B and B is associated to C, A indirectly is also associated to C. So both B and C, both of them are deemed associated entities of A Limited. All of them are associated to each other. Now, there is clause B, which says direct or indirect holding of shares carrying 26% or more voting power by the same person in each enterprise. So this is where they mean to say that if there is, let's say, some Mr. A is holding 40% share capital in X Limited, and Mr. A is holding 40% share capital in Y Limited, well, then X and Y will also be associated to each other. Why? Because Mr. A is associated with X Limited, 40%, it's more than 26%. Mr. A is associated to Y Limited. Why? Because this is more than 26%. So because they are both, Mr. A is associated to X and to Y, this is the reason, because this is the same person, X and Y will also be associated to each other. By virtue of which clause? Well, it's going to be clause section 92A, subsection 2, clause B. They are associated to each other. Now, then there is clause C, which talks about provision of loan not less than 51% of the book value of total assets. This is where they basically say that if one entity is providing loan to the other entity, well, then, these two entities will be associated to each other. Now, there are questions right here. At 51%, do you think they will be associated? If one entity provides loan of 51% of the book value to the other enterprise. Yes, that's absolutely correct. They will be associated because the law says not less than 50%, 51%. So at 50%, they will not be associated. At 51%, they will be associated. The next thing that you have to remember is that they talk about the book value of total assets. Okay, they do not talk about the market value of asset. They talk about the book value of the total asset. So if the question provides you with book value and market value, you have to make the calculation using the book value. Clause D talks about guarantees not less than 10% of total borrowings. So this is where two entities, they provide, they're talking about a loan, or they've taken a borrowing from. Another thing that you have to remember is that the law says if these conditions happen at any time during the previous year, meaning to say that if two entities were not related throughout the year, but on 31st March they got associated, then we'll consider them associated for the entire year itself. So that's because the law says at any time during the previous year if they were related. Now, this any time could be even one day, or it could be even, the entire day, entire year that they were actually associated. But at any time if they were associated, this is going to be um, considered as association, and transfer pricing rules will be applicable. Any questions? Any questions? Any of these conditions? Okay. So we'll move to the next conditions, which is basically the fifth condition, which is called as the management condition. Now, if there is, let's say, a board of director in one company, and the other company appoints more than half of the board of directors. Let's say that this particular company has 16 directors in their, board, and the other company, they appoint 10 directors in from those 16 directors, then the two will be associated to each other. So that's one condition. The second condition is even if you appoint one executive director or one executive member, or two or three, but they will be considered as associated. So even by appointing one executive director or one executive member, the two enterprises will become associated to each other. Now they're talking about board of directors or governing board. So when it comes to board of directors, remember they're looking at 50% or more. And when it comes to executive directors, they are looking at more than one or more than one. So when they talk about board of directors, they're talking about more than half. And when they talk about executive director, they talk about one. Even appointing one will cause them association for the purposes of transfer pricing. Do you think independent directors will count? No. Okay, that's absolutely correct. Independent directors will not count. This is only executive directors. Independent directors are not executive directors. So I have provided an example here. This is where they talk about 15 directors. Out of that, they appoint 8 directors out here. In such case, they will be associated to each other. The next set of conditions that we'll be talking about are more like control conditions. So this is where clause G comes into existence, and clause G talks about complete dependence on intangibles for manufacture, processing, or for business. Now this is just an excerpt from the from the clause. I would suggest that you actually go through the entire clause right here and read through it. But this is just for revisionary purposes and for you to remember that I have mentioned just like a very small portion from the clause itself. The entire clause I have mentioned here, and this is what it basically says. It's very small for your screen, but I'd suggest that you open the act and look at clause G, which is where they talk about complete dependence on intangibles. So they basically say that let's say that there is one entity. This one entity has is the owner of the intangible. It's not like they've taken the intangible from somewhere, but this is the owner of the intangible. Now, if this is the owner of the intangible and the other entity is dependent on their intangible for their business, for their manufacturing, etc., well, then the two enterprises will become associated to each other. But for this, there are two things that you have to remember. The first thing, as I mentioned, the one enterprise has to be the owner of, the intangible. And the second thing is that the other enterprise is wholly dependent. So we're looking at 100% dependence on this particular intangible. Then only they will be considered as associated for the purposes of transfer pricing. The next clause is clause H, which talks about supply of raw materials 90% or more and the prices and other conditions are influenced by the other enterprise. So if one enterprise supplies raw material to the other enterprise, and this is 90% or more raw materials, and the price is influenced by the other enterprise, this is not open. Clause I talks about goods manufactured, processed, and they're sold to the other enterprise, and is the individual income tax act. The person's daughter is controlling. Then clause L talks about AOPs and BOIs, and they talk about holding of 10% or more interest in such firm AOP BOI. Then also they will be associated. And finally, they talk about clause M, which is relationship of mutual interest. Nothing has been prescribed as yet, but they've just kept it here, saying that if there is relationship of mutual interest, then also they will be associated to each other. So, meaning to say that they have defined these 13 instances right here, 26% or more voting power, loan, guaranteed transaction, then these two management conditions, and finally these control conditions right here. And if they are within these particular conditions, if two entities are within these particular conditions, then they will be associated to each other. So yeah, this is what they, talk about. Any questions here? Any question? Okay. So if there are no questions, we will move to some questions from, past papers. And these are the three instances that we will be talking about. I would suggest that you guys take maybe 2 minutes and go through these particular. Okay, 3 minutes, 1 minute each for these three instances, and then we will discuss whether these are associated or not. So I'd suggest that you guys take 3 minutes and just look at this particular question, and then we'll discuss whether the entities are associated or not. Okay, guys, I have some answers, right here. And that's absolutely correct. But yes, we'll go through, the first. Yes, that's, yes, I think, first, second, first and second were pretty simple, and you guys have answered it. But the third needs more attention, and we'll talk about that. But let's look at all the situations right here. So if you look at situation one, this is where they talk about, and I will just not focus on the answer. I will also tell you how to write these particular answers. Now, the first thing is they say that they have advanced a loan of 53 crores on 12th January 2024. The book value they have provided, and they have also provided the market value. And then they say that they have also repaid before 31st of March. Now, a lot of things. The first clause is, I'm sure you know about the clause. It's basically the clause that, C, that talks about advancement of loan, and it is 51% or more relating to the book value. So now the first thing is you have to put the law out here, and you have to say that the law says 51% or more of the book value of total assets of the other enterprise, etc. The loan advancement. Now, this is where you have to compare 53 crores to basically 100 crores right here, because that's the book value. You cannot compare it to the market value, which is 150 crore. If you do that, the answer will be wrong. Also, if I've seen a lot of times people try to, because they have repaid 10 crores, they try to minus 10 crores right here, and they basically say some other amount right here. But because they have a reach 53 crore, and the law says at any time, so if any time it was 53 crore, and that is what we will be looking at. So this is the reason that there will be association, yes, because 53 crore is compared to 100 crores right here, and that's more than 51%. The second thing is the power to appoint 2 out of 4 directors. Now, if you look at the law says more than 50%. In this particular situation, the board of directors are 4, and they have appointed exactly 50%. So there will be no association, they will not be associated, because they have not appointed more than 50%, they have appointed at 50%. The third one, there is no association even in the case of third one. You will see, you might just say why, because that is because this is coming out to be 820, which is more than 90%. But then the thing is that they say that at prices mutually agreed upon, and depending on market conditions. This is where they say that supply is 90% or more, and the prices are influenced by the other enterprise. In this situation, they say that yes, it is depending on market conditions, but it's also mutually agreed upon once in 6 months. Because the prices are mutually agreed upon, they will be considered as not associated enterprises. This is upon market conditions right here. So yes. uh okay. Okay, there are some questions on the chat tab. Will it be possible for you to unmute yourself and, just ask the questions? Or you can just put it on the chat tab, okay?
I'm actually on the situation number 3. I thought 2 question separate question, but it's a single. I thought only single question. It's a 2 question separate.
Yeah,
On the
because
situation 3.
yeah, because there's an and in between.
Okay, that is what.
This is the law. I have provided the law, so it's easier for you guys to just relate to the law, because I see a lot of times that people actually they actually want me to just explain this particular situation. Um,
Yes, ma'am. Exactly.
yeah,
I got your point. That
yeah,
is the reason I confused actually.
yeah. So
Since you. Mm.
so sorry, if you just read through the law, it says that supply is 90% or more. So, we actually try, we actually say that, yes, this is 90% or more, but this is where they say that prices and other conditions should be influenced by the other enterprise. So, in this particular situation, they say that the prices are depending on market conditions. Now, because the prices are dependent on market conditions, this is the reason, even if the supply is 90% or more, we cannot call them associated enterprises. Should I explain this again?
Yes, ma'am, I got it, ma'am. Since it is a open market price, then there is no issue.
Absolutely.
Right, ma'am. Thank you.
Thank you so much. Okay. This is now, so these are all the conditions that you have to, just go through so as to see when are they associated or not. The next set of discussing is basically section 92 B, which talks about international transaction. Now, these are the international transaction that they actually talk about. They, if there is a transaction between two entities, and this transaction could be a tangible property transaction, so one entity is purchasing something from the other entity, or it is an intangible property transaction, one entity is purchasing or transferring their intangible, or even if they're using someone else's intangible, that is going to be considered as an international transaction. Even if there is long-term borrowing, lending, if there is guarantee, or if there is loan advancement, etc., those will be considered as international transaction. Even if there are services out there that are provided, so when entity provides IT services to the other entity, then also they will be associated. If there is a business restructuring transaction, then also they will be associated. So if there is a merger or there is a demerger, then also they will be considered as associated entity. I think the topic that requires attention right here is the concept of deemed international transaction. Now, we'll talk about deemed international transaction, and we can take a break after that, because I want you guys to take a break before we discuss the methods. That's where technicality arises. So very quickly, I will be talking about what is this deemed international transaction. Deemed international transaction is a concept that they came in because there were tax avoidance strategies again that was actually happening. This is the reason they came up with deemed international transaction in the law. So this is where they talk about, let's say there is a foreign associated entity and there is an Indian enterprise. There is this Indian company and they have a foreign entity and it's an associated entity. Now, if these two entities, they transact between themselves, obviously transfer pricing provisions will be applicable. Why? Because one, there is Indian entity and overseas entity. Second, they're associated to each other. And third, they are having an international transaction. So transfer pricing provisions will be applicable. So this is the reason this decided to, circumvent transfer pricing provisions. They decided that let's have an unrelated person right here. What is the benefit? Well, the Indian enterprise will transact with this unrelated person. And what is the benefit? Well, if Indian enterprise transacts with this unrelated person, obviously transfer pricing provisions will not be applicable. Why will they be applicable? Because this is not related, so transfer pricing provisions will not be applicable. But what is the benefit? Well, they decided that Indian enterprise will transact with the unrelated person, but whatever that they transact at, whatever is the price, whatever are the other conditions at which they transact, that will be determined by the foreign associated entity and the unrelated person. How? Because there will always be a prior agreement between this foreign associated entity and this unrelated person also. So what I'm really trying to say is that the Indian enterprise will transact with the unrelated person, but in substance, they are transacting with the foreign associated enterprise, because whatever is the price at which these two entities are transacting, that is determined by the foreign associated enterprise. So it looks like these two entities are transacting, but in essence, it's actually the foreign associated entity transacting with the Indian enterprise. They've just plugged, this unrelated person, right here. They're not really transacting, but it just looks looks like, these are transacting. So if this is the situation, the law came up with something called as deemed international transaction. And they basically said that this particular, transaction between the Indian enterprise and the unrelated person will be called as a deemed international transaction, and transfer pricing provisions will be applicable here. I do understand that this is a transaction between an Indian entity and a non-related person, but still this will be called as deemed international transaction, and transfer pricing provisions will be applicable. So that's the concept of deemed international transaction. Then what did they do was they expanded the scope of deemed international transaction in 2014, and they said that even if the transaction is in India, even if this unrelated person, even this unrelated person is in India, then also this will be called as a deemed international transaction. So in this situation, let's say that there is ICO and then there is FCO. ICO transacts with this non-AE. And whatever is the price at which these two entities transact, the price is determined by FCO. So it's actually like FCO and ICO transacting, but they've just, given it in essence, given it a flavor of ICO and this non-AE transacting. This is the reason the transaction between ICO and non-AE will be considered as a deemed international transaction. Now, you might say that, this is an unrelated party, but still this will be called as a deemed international transaction. Now, again, if you see, this is an Indian company, this is an Indian company, but still they said that this is going to be an international transaction. This is considered as a deemed international transaction. It does not matter whether this non-AE is outside India or it is in India, still it will be called as deemed international transaction, and transfer pricing provisions will be applicable in this situation also. So that's the concept of deemed international transaction. Now, the next part is basically where they talk about what is, the transfer pricing methods that are out there. What are the methods that are available to compute this something called as arm's length price? Now, if you look at this particular diagram, we were discussing that, they transacted at 80 rupees. 80 rupees is not, the arm's length price. What is the arm's length price? Is it 120? Is it 150? Is it 100? What should it be? Now, for this particular reason, they have provided something called as transfer pricing methods right here. Now, if you look at the transfer pricing methods, we have some 6 methods out here. There are some traditional methods, which is called as CUP, RPM, CPM, cost plus method. And then there are traditional transactional profit methods, which is TNMM and profit split method. And then there is another method in India, which is called as other method. Now, if you look at these particular methods, there was a time that there was a hierarchy of method, but now we don't have any hierarchy. We have something called as the concept of most appropriate method. What is the most appropriate method? They say that you have to look at the facts and circumstances of each situation and then decide whether CUP will be the method, whether TNMM will be the method, or profit split method will be applicable. So you'll have to look at these particular methods so as to see what is the most appropriate method, which provides the most reliable measure of the arm's length price. What is the most suited to the facts and circumstances? So let's take a 10-minute break right here, and then we will come back and discuss with something called as the CUP method. Can you hear me? Can you see the slides? Okay. Okay, so we were talking. We're talking about the first method, which was basically, something called as the comparable uncontrolled price method. This is called as, the CUP method. What does it mean? It basically means that, you can adopt the price of this uncontrolled transaction as the arm's length price, provided it is comparable. This is the reason the method is called as comparable uncontrolled price. What is the uncontrolled price here? Well, 120. But then you will have to make sure that are the two parties, comparable to each other. Well, if you say yes, well, then this is, you can adopt 120 as, the arm length price, and 80 will be substituted by 120. But then for these two to be comparable, you will have to look at a lot of, factors out here. You will have to make sure that, the product that you're talking about is the same, the time period of the transaction is the same, the functions of the two entities are, the same, the business strategies or, the economic circumstances are the same. So as long as all these situations are the same, well, then you can adopt 120 as, the arm's length price. Now, when you talk about the arm's length price, there are two CUPs out here. There is something called as external CUP, and then there is something called as internal CUP. External CUP basically means that, let's say that there are two associated entities, and one entity is selling, let's say, unbranded Colombian coffee beans to the other entity. Now you want to make sure that this is at arm's length. How will you make sure? Well, you look at two independent enterprises in the market. Maybe they are also selling unbranded Colombian coffee beans. Now what you can do is you can adopt their price as the arm's length price right here. But then for this, you'll have to make sure that the commodity is the same. Unbranded Colombian coffee beans, unbranded Colombian coffee beans, something that's specific. Is the country the same? Yes, the country is the same. Economic circumstances are the same. The transaction time is the same, etc. If all these situations are the same, that you can adopt this as the external CUP price. Then there is also something called as internal CUP. Internal CUP basically means that if ICO is selling unbranded Colombian coffee beans to a related entity, which is FCO, you want to make sure what is the price at which this transaction has happened. Is it at arm's length price? What you can do is you can look at the fact that ICO is also selling unbranded Colombian coffee beans to another entity, to like a non-AE out here. So they're selling to associated entity, they're selling to non-associated entity. Whatever is the price at which they're selling to non-associated entity, you can adopt that as the arm's length price for this particular controlled transaction. So that is basically called as internal CUP. The next method that we have is something called as the resale price method. Now, resale price method is a method which is basically applicable for traders and distributors. This is where, let's say that there is a parent company, they are a manufacturer and they are selling the commodity to a trader in India, and the trader or the distributor right here, this subsidiary company as the distributor, they are distributing it to the end customer right here. Now, if the parent company is selling the commodity at 75 rupees to the distributor is selling it at 100 rupees to the end customer. Now, this is the controlled transaction of 75 rupees. You'll have to justify that 75 is at arm's length. How will you justify? Well, you can look at other parties in the market. Maybe those are also selling at 75. If yes, this is at arm's length. Alternatively, what you can do is you can look at the profit margin at the subsidiary company level. What is the profit margin of the subsidiary company? It's 25% or it's 25 rupees. Now, if this particular price which is paid by the subsidiary company of 25%, this is at arm's length if you find out independent parties, and those independent parties also have a margin of 25%. Or if the independent parties, sorry, if the independent parties have a margin of less than 25%, then this is at arm's length. So what I'm really trying to say is that this particular distributor has a profit margin of 25%, or it's greater than what other parties are actually earning. Then this is at arm's length. So this is what you have to prove in resale price method. I think what is important for you guys to remember for resale price method is that this is applicable for traders and distributors. This is where no intangible asset is applied. This is where that there is no major value addition at the level of the subsidiary company. If the parent company sells the product to the subsidiary company as it is sells the product to the end customer. There is no value addition as such at the subsidiary company level. Well, then this is called as resale. And this is the resale price method. Then there is something called as the cost plus method. The cost plus method is where the subsidiary company is a manufacturer. This particular method is applicable for contract manufacturing, for manufacturing for semi-finished goods which are sold between related parties. So let's say that there is a subsidiary company and the subsidiary company is selling the commodity to the parent company. The subsidiary company has direct and indirect cost of production, let's say of 100 rupees. Then the subsidiary company sells the commodity to the parent company at 125 rupees. Now you have to substantiate that 125 rupees is at arm's length. How will you do that? Well, you can calculate the margin at the subsidiary company level. What is the margin that they have retained? Again, 25%. If you're able to establish that this other people in the industry, independent parties also are earning a margin of 25%, or they are earning lesser margin. This particular subsidiary company is earning greater margin, which is 25%. Well, then this is at arm's length. So this is what you have to do. But again, what you have to remember are circumstances where this particular method will be applicable, which is contract manufacturing or semi-finished products being sold between the subsidiary and the parent company. Then there is something called as the transactional net margin method. The transactional net margin method basically examines the net profit. Now, in this particular situation, you'll have to calculate the net profit in a particular transaction. So what you'll do is, let's say that there is an Indian company. The Indian company is providing IT services to the foreign company. Now, what you'll do is from this particular transaction of providing IT services, you calculate the net profit and you compare the net profit in this situation, you compare the net profit of independent situation, compare it, and then you will be able to establish whether this is at arm's length or not. The what we actually compare is basically a ratio. So we calculate a ratio right here, and that is basically called as profit level indicator. It's basically a ratio of net profit divided by the relative base. So what you have to do is you have to calculate the PLI of the related party transaction. So net profit by cost or net profit by sales or net profit of assets of the related party situation or the controlled transaction, or the net profit of the uncontrolled transaction. You have to compare the two so as to see if the transaction is at arm's length, or not. This is something called as profit level indicator that you need to compare. Now, the point is, what do you actually compare? Do you compare, the Indian entity, calculate the margin of the Indian entity and compare it with Indian independent enterprises, or you calculate the margin of the US entity and compare it with US enterprises? Whatever you choose is basically called as, what is it called? Okay, before I answer this, which party do you test? What is it called? What is the terminology for that? Okay, anyone who knows? Which party are you testing in the TNMM method? What is the name of the party? It's called as the tested party. So whatever entity that you actually test is called as the tested party. There is no definition for tested party in transfer pricing regulations. but it's generally the least complex entity, which is called as the tested party. Now, it depends on what is the least complex entity, which does not own significant intangibles, which require least adjustments, for which financials are easily available. That is called as the tested party. The next method that is there is basically called as the profit split method. For the purposes of profit split method, what you have to remember is that this particular method will be applicable where the transactions are very, very interrelated to each other. You cannot segregate the transactions out here. Also, when you see an intangible transaction involving intangible assets, that is where you will adopt something called as the profit split method. In this particular situation, what we do is we calculate the profit, and then we split the profit between the two enterprises using a functional analysis or using like a profit split percentage, which independent enterprises also indulge in. So that is called as the profit split method. And then there is something called as the other method. The other method is a method, uh, basically any method which basically talks about the price that would be charged in a similar situation. So this is the method that talks about third party quotations. That if we transact, this is the price at which we will transact. That is basically called as the other method. So what we do is we look at third party quotations, and that is the price that we actually transact at. So what I've done is, I think it's very important for you guys to know which method is applicable when. So this is the summary slide that I have provided so as to for you guys to understand which method will be applicable, in what situation. Okay. This is the question that was in Jan 2021, which talks about which method will be applicable in which situation. Please just take a minute and read through situation one and let's discuss it. What do you think will be applicable here? Okay, which method do you think will be applicable in the first one? Any idea? Okay, COP method can be applicable, is comparable, is available. But then the thing is, okay, I'll tell. Okay, COP can be applicable in, the first one. Uh, COP can be applicable, but for you to answer this particular question, TNMM could also be applicable. There is always, this confusion between COP and TNMM. The thing is that you can write COP also, provided that you'll have to provide in that everything is comparable. So you'll have to give that particular, situation right there. Otherwise, TNMM is something that can be applicable very, very easily, right here. Um, Uh, this one, yes. So this is the reason they say as compared to the goods regularly sold to third parties. Now this is where you will have to put in like a condition out there that it's actually as per, the variation and customization is provided here. But if you're able to account for this particular variation and customization, if you can account for this particular difference, well, then CUP could be applicable. Let's look at the second one. What do you think will be the applicable situation, applicable method in second one? Yes, the second one is going to be CPM, which is the cost plus method. I think this is very easy. What are the cues that you'll pick up? The first thing, it manufactures semi-finished products. And then it adds a gross profit markup. This is on indirect and direct cost of production. So you know that this is going to be like the cost. And then there is a plus plus out here. So this is going to be the cost plus method. And then the last one. No, I think there is something which is better than TNMM that can be applicable here. Yes, a COP will be better suited here. Why a COP? Uh, because they say that they provide services both to related and unrelated parties. This is the reason you might have data available easily for related parties, and that's the reason, for sorry, data easily available for unrelated parties, and that's the reason this could be subject to a COP method. The reason is that if you have a method, obviously you can apply TNMM also here, but then the thing is that if you have data available, then you would like to approach a CUP method first and then, go in for a TNMM. So looking at the situation, a CUP is, something which is better as compared to, a TNMM out here. So you can say a CUP will be applicable. This is, you know, uh, the slide which basically, now this is, after we've done all the methods, this is where they talk about what is the data that you will be using for analyzing comparability. So, are you comparing it to just 1 year, or can you take it other years also? So there was a time that current year data was applicable, but now they say that data relating to two previous years also you can take. If you look at current year data, it's always distorted by differences or market conditions, or out there. This is the reason now multiple year data can also be taken for the purposes of comparability. So what you can do is, just to give you an idea, let's say that you're comparing the profit margin in two situations for the independent party. Now profit margin of that current year is also available. What you can do is, you can also take the profit margin of last 2 years, sorry, calculate a weighted average of 3 years and compare that weighted average with our margin, with the client margin, or with the taxpayer's margin. So you can take multiple year data, but then there are conditions out here. This is only applicable for RPM, TNMM, and CPM. And for transactions entered after 2014, you can take multiple year data. Now the thing is, uh, now the thing is that how about arithmetic mean? Now let's say that when you were using TNMM method, your client's margin was, let's say, 15%. Now you found out comparable companies, and then you found out, let's say, 12 comparable companies. Now the thing is, how do you compare this to 12 comparable companies? Now this is the reason India came up with the concept of interquartile range. They say that for these 12 companies, you calculate a range out here, 35th percentile and 65th percentile. And if your margin, if let's say my taxpayer's margin is 15%, if it falls within that particular range, well, then it is going to be considered as arm's length price. So let's say that the taxpayer's margin, and I'm typing it on the chat box, taxpayer's margin is 15%. The range I calculated, which is 35th percentile to 65th percentile, the range is, let's say, 5% to 18%. This is the range. Do you think it's at arm's length? Yes, this is going to be at arm's length because it's falling within the range itself. Now, what you have to do is, this range concept is applicable when the number of comparables are six or more than six. So if you have, six, so if you have six comparables or more than six comparables, then you use an interquartile range, which is 35th to 65th, percentile. But then the thing is that India says that if the number of comparables are, five or less than five, or basically less than six. So for two comparables, for three, four, and five comparables, we use something called as an arithmetic mean. What we'll do is we'll calculate a arithmetic mean of all the comparables, and then compare it accordingly. So this is what this particular slide says. The next concept that we have for today is transfer pricing documentation. Now, this is the importance of transfer pricing, documentation. When you look at transfer pricing documentation, generally there are two things that we have to do. There is something called as an accountant's report, and then there is something called as, a transfer pricing study that we have to maintain. Now, there is something called as an accountant's report, which is also called as Form 3CEB. This particular form is mandatory. Even if you have a transaction of 1 rupee, an international transaction, this particular form is mandatory to be filed. It can be filed by practicing chartered accountants, and this will basically provide an opinion that the value of international transaction is at arm's length. Now, this particular form is mandatory. You must have heard of, very, very casually, people say you must have heard of something called as TP return, transfer pricing return. This is basically that. Don't call it transfer pricing return. This is called as Form 3CEB, or it's called as accountant's report. This is a mandatory filing when transfer pricing provisions are applicable. Apart from this, there is something called as this is what Form 3CEB really, incorporates. Very, very briefly, they just talk about, the details of the associated entities. They will talk about what transaction has been undertaken, and they will just mention what is the method that was actually used. Now, you don't have to give any details out here. You just have to mention what was the method that was actually, provided for the purposes of substantiating that this is at arm's length. So this is basically Form 3CEB. Apart from Form 3CEB, there is another thing that you have to do, which is called as, the transfer pricing study report. TP study is what you might have, heard. This is coming from Section 92D, read with Rule 10D. Now, TP study is a very, very extensive document. This particular study will talk about everything relating to the transaction that has actually happened. So it will talk about, the ownership structure. It will start by saying, what does the taxpayer do? What are the associated entities of the taxpayer? What are uh, the ownership structure? How are they associated? Where are they located? What do they do? What is the business of the taxpayer, etc.? They will talk about everything. Then they will talk about the transaction. What was the transaction that was actually undertaken? So if you say that it was an IT services provision, then they will talk about what are the kind of IT services. How is there an intercompany agreement to substantiate this particular transaction? Then they will talk about how have you computed the arm's length price? What method have you used? Have you used CUP? Have you used TNMM? If you say that you have used TNMM, then they will talk about the transfer pricing database that you have used. How did you come up with comparable companies? Are you using current year data? What was the tested party? Um, are you using interquartile range or arithmetic mean, etc.? So everything relating to the transfer pricing, documentation is provided in the transfer pricing study, which is section 92D. So this is a very, very extensive documentation. Do you think there is a threshold limit for TP study? Threshold limit here? Yes. Okay. What is the threshold limit? 1 crore. Well, this is the TP study. The threshold limit for TP study is 1 crore. And this is not 6,400 crores. Don't get confused. That is something else we will be talking about. So this is basically, the TP study, which has a threshold limit of 1 crore. The reason that I'm talking about this also is because there was a question, I think, a few years back, which basically talked about the threshold limit for TP study. They were trying to confuse you with other, thresholds. The threshold limit for TP study is 1 crore. So only if transactions, exceed 1 crore, will you be maintaining TP study. But then the thing is, remember, for Form 3CEB, there is no threshold. So if there is a transaction of 50,000 rupees, Form 3CEB is still mandatory, but TP study is, okay. You don't have to, maintain like a TP study there. This is the three-tier documentation structure I'm sure you know about, which is basically BEPS Action Plan, 13, which is where they say that now you have to maintain something called as a local file, master file, and CBCR. These are the three things that you have to maintain. And the threshold here is basically 6,400 crore for something called as country by country report. Now, local file is something which is filed to be filed in with the local authority. So let's say that there is a parent company in India. I'm going to put it on the chat box actually. Okay. Parent company is India and subsidiaries are in Germany and let's say China. Now, in this particular situation, India will file a local file with Indian tax authorities. Germany will file a local file with German tax authorities, and China will file a local file with Chinese tax authorities. This local file is a very entity, like a transaction specific document. It's a very entity specific, document. All the transactions that you have undertaken with related party, you have to give like a lot of detail, to that particular jurisdiction's tax authorities. So this is something you can say like, the TP study that we already have right here. Then there is something called as a master file. So master file is basically like a high level overview. This is where you'll talk about, the business of the international group. What are the group transfer pricing policies? What are the R&D centers? Like very overview you will give of the business enterprise. And this again, you will file in three jurisdictions. So India will file with Indian tax authorities, Germany will file with German tax authorities, and China will file with Chinese tax authorities. There are threshold limits, for master file that I have provided here. The threshold limit for master file is basically 500 crores of group revenue and aggregated value of international transaction of 50 crore. Or if there is a intangible transaction, it should be 10 crore. Meaning to say that for master file, the threshold is 500 crore. This is the group consolidated group revenue plus 50 crore or 10 crore. Just look at the chat tab, I've provided it here. 500 crores of consolidated group revenue, that's important, plus, and there should be 50 crore of international transaction. If that is not there, there could be 10 crore of intangible transaction. Anything, this is the master file. Master file has two components. There is part A and part B. Part A is mandatory for everyone, but for part B, this is the threshold that will be applicable. Okay. Then there is something called as a country by country report. Now, country by country report is filed in the parent company's jurisdiction. So for the purposes of our example, the parent entity is India. So country by country report will be filed in the with the Indian tax authority. And this is where they'll talk about aggregate information. So in that CBCR, they'll talk about that, India, this is the revenue, this is the profit, this is the income tax paid, these are the employees, etc. For Germany, these are the revenue, this is the profit before tax, these are the employees, these are the capital retained earnings. And the same thing they'll give for Chinese tax authorities. So this is the reason they'll give like a aggregate tax jurisdiction wise information in the CBCR. Now, the threshold limit for CBCR is something called as 6,400 crore rupees. This is the consolidated group revenue. This is going to be, you can look at the CFS, the consolidated financial statements. There, the group revenue should be 6,400 crores, and then only CBCR, which is this one, this will be applicable. So this is the three-tier documentation structure which is, provided. This was the the question that was asked very lately. that what are the advantages of the three-tier BEPS action plan, documentation structure. So these are the three things that you can talk about. That if you look at the three-tier documentation structure, the taxpayers will be required to articulate consistent transfer positions. So whatever they have provided in their local file, that can be matched with the CBCR. So that is important. Tax administrations will get useful information, and they will be able to make determination about where resources are going to be deployed for transfer pricing audits. So that is the advantages that you can talk about. Okay, any questions here? Okay, thank you. Now we move to the next concept, which is basically called as safe harbor rules. Safe harbor rules are basically, like circumstances. So what I'll go here and explain this. So what they've done is, because there was a lot of litigation on some basic transactions, like if the entity provided IT services to the other entity, let's say an Indian entity provided IT services to a foreign associated entity. Now, taxpayers already they always said that the markup in this particular situation, the profit margin is basically 10%, just as an example. But the tax authorities also always said that no, the margin here should actually be the margin should also be something called as 20%, etc. So there was a lot of litigation. The taxpayers always said 10%, the tax authorities always said 20%, etc. So this is the reason, just to make sure that there is no litigation that is actually happening, the tax authorities have CBDT came up with something called as safe harbor rules. So they have listed down specific circumstances in Rule 10 TD, and they have mentioned these specific circumstances against which they have mentioned what should be the operating profit margin that will be accepted by the tax authorities. So this is where, let's say, for an example, they have mentioned software development services. They say not less than 20% where the aggregate value is of transactions is 500 crore, and not less than 22% where it exceeds 500 crores. Similarly, they have provided information technology. What should be the margin that will be accepted? 20% or 22%. So this is the reason they have mentioned eligible international transaction, against which they have mentioned how much will be acceptable. So this is called as safe harbor rules. This is where I've mentioned, some of the transactions right here: software development services, information technology enabled services, KPOs, intragroup loans, intragroup services, etc. And this is where I've mentioned the meaning. So it provides certainty, it provides compliance relief and administrative simplicity, because you know what will be accepted by the tax authorities now. A question on the group. Can you give brief information about OECD and BEPS action plans? So OECD is basically this organization which provides rules for the purposes of international tax, apart from other things also. Uh, OECD, because I mentioned initially that, because there was a lot of profit shifting that was happening, because there was a lot of base erosion that was happening, OECD and G20 countries got together and they framed these action points. They framed OECD BEPS action plans. So, what they did was, they looked at 15 areas out here, and they said that where is tax avoidance actually happening. They looked at 15 areas. So they basically said that these are 15 action plans. These are the areas where profit shifting is happening, where tax avoidance is happening, and they tried to frame rules out here. So the first one was basically digital economy. They basically said that, which is also action plan one. Action plan one is taxation of addressing the tax challenges of the digital economy. They basically said that because everything is becoming digital now, all the entities are making websites and they are not paying their fair share of taxes because they say that we do not have a structure in that particular in that particular jurisdiction. This is the reason they are not paying their taxes out there. So they came up with action plan 1 and they said that we will make rules to tax the digital economy. Similarly, they came up with action plan 8 to 10. That is for transfer pricing purposes. That is for intangible transactions, etc. Similarly, they came up with Action Plan 13. Action Plan 13 was basically transfer pricing documentation. They said that if transfer pricing is applicable, then you have to maintain something called as a three-tier documentation structure, which is local file, master file, and country by country reporting. So it was actually OECD BEPS Action Plan 13 that came up with this three-tier documentation structure. Now, because India follows OECD G20 BEPS action plan, India is part of the G20 nation. This is the reason India adopted the recommendations of BEPS action plan 13, and India said that we will incorporate this in the Indian Income Tax Act. So they came up with section 286. Now, if you look at section 286, they have incorporated whatever OECD BEPS Action Plan 13, basically said. They have incorporated that in section 286, and that basically is the country by country report, which we just talked about. I think this should be, covered in the earlier lectures also. I think this is something which is very important, BEPS action plans. So yeah. So likewise, what I can do is towards the end of the lecture, I will send you probably a slide deck that talks about OECD BEPS action plans, um, in a lot of detail. There are also some video links in that particular slide that you can actually look at, which explains BEPS action plan 13 and BEPS action plans generally also in like a very interesting way. So you can I can just send those links and those PPT also. I'll upload it with this particular PPT itself. Okay, the next concept is basically called as APAs. And APA, just to give you a, just to make things easier for you, APA is basically like an agreement between the tax authorities and the taxpayer. Now, again, as I mentioned, there was a lot of litigation happening. Let's say IT transaction. The taxpayer has provided IT services. So there was a lot of litigation, on what should be the appropriate margin, what should be the method, or, what should be the transfer pricing adjustments, if any, on this particular, transaction. So this is the reason they decided that let's have the taxpayer and the taxing authority sit together and they will decide and they will come to a terminology, they will come to a conclusion that what should be the transfer pricing method, sorry, or what should be the comparables that should be applicable to this particular transaction. So in advance of the transaction, they determine an appropriate set of criteria that, what should be the method. The taxpayer says that this is year one that we have undertaken this transaction. Now, going forward, also, we'll have this particular transaction. Now, what should be the method? So they decide, together on what should be the appropriate transfer pricing methodology. That is basically called as an APA, an advance pricing agreement. Now, if the taxpayer and the tax authorities, they come to an agreement that this is going to be an appropriate transfer pricing methodology, this is going to be binding. The APA is going to be binding on the person who's taken the APA and the PCIT, the principal commissioner or the income tax authorities. There it will be, binding. Whatever they decide, that will be binding onto them. There is no doubt a lot of negotiation that happens. It has to be, the consent of the signing parties, and it's actually based on a lot of assumptions out here that, going forward also you will be undertaking this particular transaction. If there is a change in law or if there is, a change in facts in the taxpayer's circumstances, then the APA will not be binding. This is the slide which talks about the APA, filing fee out here. You can, look at that. And this is where the APA will be valid. So generally an APA is valid for 5 consecutive years. So today I can sit and I can take an APA for 5 years. That means that for 5 years, I can decide that what will be the method that will be accepted by the tax authorities, what will be the comparables that will be accepted by the tax authorities, and there will be no litigation out here. So it is applicable for 5 going forward years. Now, one thing about APA is that it is also applicable for last 4 years. So you can have something called as a rollback provision in APA. You can take APA for the previous 4 years also, that whatever has happened in the last 4 years also, that will be accepted. So in India, you can get a total certainty, a total period of APA can be 9 years. How 9 years? 5 years going forward is the maximum period. And then 4 years also, you can take it for backwards, which is the rollback provision. So in India, you get it for 9 years, maximum. This is the slide that talks about a few things relating to the APA. I think this is where I've summarized it all. Can it be revised? Yes, APA can be revised if there is change in law, if there is change in critical assumptions. Can the APA be cancelled? Yes, if there is compliance which is not undertaken, APA can be cancelled. Can it be renewed? Yes, it can be renewed. And can the APA be withdrawal can happen? Yes, you can withdraw APA, but fee will not be refunded. So, you can read through this in a lot of detail. It's provided in the manual, but this is where you can, rely on for the purposes of revision. These are some of the these are the questions that was actually asked. I'll request you to take a minute and read through this particular question. Just read through the first question right here. Okay. Do you think APA can be taken up for company XY? Yes, that's absolutely correct. It cannot be taken because you've taken it for company X and company Y. Now, when you take an APA, just remember that, as I mentioned before, it's on negotiation, it's on facts, it's on, the particular company itself. If you form a new company, obviously there will be change in facts, so many changes, and you cannot carry forward that particular APA, that ways. The second one is November 2019, which basically says an APA once entered by the taxpayer with the income tax authorities cannot be modified or revised. This is absolutely incorrect. It can be modified. Yes, that's absolutely correct. Your answer is absolutely correct. It can be modified or it can be revised. So for this, you can rely on these particular rules, that are provided here. The next concept is basically something called as secondary adjustment. Just to give you a perspective, I think this is what we were talking about, this particular slide. So we were talking about this particular situation, which is 20 rupees. So in this situation, we were talking about related parties and how there was a profit of 20 rupees. Why was there a lesser profit of 20 rupees? Well, that is because they tainted the sales right here. They transacted at a price which is 80 rupees, which is not the arm's length price. Hence, their profit was less, which is 20 rupees. So now there will be a transfer pricing adjustment right here. What will be the amount of transfer pricing adjustment here? Can you guess? What will be the amount of transfer pricing adjustment here? Yes, that's absolutely correct. It's going to be 40. So there will be a 40 transfer pricing adjustment. Now, this transfer pricing adjustment is something called as a primary adjustment. That is called as, the technical terminology is primary adjustment. Now the thing is that yes, there is an adjustment of 40 rupees, and now the tax authorities will calculate the tax on 60 rupees. 20 plus 40 transfer pricing adjustment. The tax will be calculated on 60, which will be 18. Now the thing is that there is now a requirement that you should bring back, or you should get 40 rupees remitted also to your accounts. You should ask your associated enterprise to give you or to remit you 40 rupees, which is, the added profit. That remittance is basically called as secondary adjustment. It basically means that you should ask. This is where I've provided here. It basically means that this is an adjustment to the books of accounts. So what you'll have to do is that there should be an actual allocation of profit. There should actually be a remittance of 40 rupees to your accounts. What happened in the primary adjustment is that the tax authorities presumed and they added 40 rupees. But now 40 rupees should also come, should be remitted from the associated enterprise. That is basically called as secondary adjustment. Now, it came in from the Finance Act of 2017, and after that, they introduced secondary adjustment provisions out here. When is secondary adjustment applicable? When there is a primary adjustment. A primary adjustment should be more than 1 crore rupees, then only secondary adjustment will be applicable. So it could be, that the tax authority, that the taxpayer has suo moto made a primary adjustment, or if the primary adjustment is made by the the assessing officer, or there was an APA safe harbor rule or map because of which primary adjustment happened. As long as there is a primary adjustment, and this primary adjustment is more than 1 crore rupees, and this is after 2016-17 assessment year, well, then secondary adjustment will be applicable. So this is where I've just provided, like a brief on, you can use this particular table to actually revise through the concept. It says that, let's say that there is an Indian company. The Indian company was transacting at a price which is not at ALP with its non-resident AE. This has resulted in increase in total income, or there is a decrease in loss. That means that there is a primary adjustment. What is the primary adjustment? It's more than 1 crore rupees. Well, then there will be something called as secondary adjustment. Now you'll have to make sure that this, let's say that this is 40 crore rupees. Now you'll have to make sure that this 40 crore rupees is remitted to India within a matter of 90 days. Well, what if it is not remitted? Well, the Indian tax authorities, they say that we'll presume that this is a loan that you have given to the associated entity. Saying it again, ideally, this 40 crore rupees should come to the Indian entity. What if the associated entity is not remitting it? Well, Indian tax authorities, they say that we'll presume that the Indian entity has given a loan of 40 crore rupees to the associated entity. And if you've given a loan, obviously you will be charging interest on that particular loan. So now what they'll do is they'll impute an interest, like a deemed interest, or like a deemed interest on a deemed loan of, for the Indian entity, and they will tax that particular interest in the hands of the Indian company. So saying that again, this 40 crore rupees should come to the Indian entity. What if it's not coming? Well, the Indian tax authorities will presume it to be a deemed loan. What if it is a deemed loan? Well, there will be an interest that will be charged, and this particular interest will be added in the hands of the Indian company, and the tax authorities in India will, tax that particular amount. So this remittance should happen within a period of 90 days. From which period interest has to be added in the income? I'm just coming to that. From which period it will be added. So this is the slide where they say that non-repatriation is going to be considered as an advance, or it will be considered as a deemed loan. Now, this is the slide which actually talks about the time limit. They say 90 days, but 90 days from when? Well, if there is a suo moto adjustment, if the taxpayers itself has done a primary adjustment, well, then the 90 days will be from the date which is mentioned here, from the due date of filing the return of income, because in the return they might have, done a suo moto adjustment. If it is from the order of the assessing officer, so then it's going to be 90 days days from this particular order. If it is from the APA, well, then it is going to be the end of the month from which the APA has happened, 90 days from then. If it is because of, a map, well, then the date which is provided in, that particular order, 90 days from then. So basically, it's basically 90 days from according to the situation, which has, given rise to something called as a primary adjustment. Now, this is the slide that talks about how much will be the interest. Well, if the transaction is in Indian rupees, well, the interest will be 1 year marginal cost of fund plus 325 basis point. And if it is denominated in foreign currency, then it's going to be LIBOR. The thing is that, uh, CBDT has not replaced, LIBOR right here, but they have acknowledged a move away from LIBOR. So they do say, practically we've been using something else, but this has not been replaced as yet. This is still LIBOR in the rules itself. Now, this is, another thing that they have actually mentioned. They basically say that, there is an option to pay additional tax. They basically say that what if there is repatriation which is not coming from in, 90 days, which is just not coming. Well, then they say that you have an addition, you pay an additional tax, and we will not ask for repatriation. So if the associated entity, they give an additional tax of 20.9664%. So if there's a tax of 18% plus surcharge of 12% plus cess at the rate of 4%. So if there's an additional tax of 20.9664%, you give this particular tax, then there will be no repatriation that will be, required. And the thing is that this amount will not be, this will be the final payment of tax, but there will be no deduction which will be allowed for this particular income tax, additional income tax that will be actually paid. But if you pay this amount, then you don't have to repatriate at all. Any questions? Any questions? Okay. Now, the next concept which we'll revise is basically called as the limitation of interest deduction. Now, this is, where they talk about Section 94, which basically says that, what multinationals were actually doing is, when they had to raise capital, you can either do a debt or you can do an equity. But they were actually using higher level of debt in the company. Why were they doing that? Because if there is higher level of debt, there will be, uh, interest out there, and they can claim excessive interest deduction. So if they give debt to the related party, there will obviously an interest out there. If there is an interest, you can claim deduction for that particular interest. That is basically the reason they came up with limitation of interest deduction. So they came up with Section 94B, and they said that we'll put a cap on how much interest you can actually take as deduction. That is basically Section 94B. Now, this was also coming from OECD BEPS Action Plan 4. BEPS Action Plan 4, OECD came up with that, and they said that you can put a cap. They gave like a lot of ways, and they say that you can put a cap also for interest deduction. India, accepted the recommendations or incorporated the recommendations of OECD BEPS Action Plan 4, and they came up with Section 94B. And they said that you can put a cap on what is the interest that can be actually deducted. What is the interest deduction? It is the interest that you're actually paying or total interest minus 30% of EBITDA. Whatever is less, you can actually claim, you can just claim an interest till that particular amount. And this particular section is only applicable where interest, it exceeds 1 crore rupees. Expenditure by way of interest is more than 1 crore rupees. Only then this will be applicable. This is, I think, this is from the manual itself, but I think this is a very good slide because it, provides for, like a summary of interest deduction rules. The first thing that it asks is the borrower an Indian company? If you say yes, uh, then only Section 94B will be applicable. Because if the borrower is not an Indian company, then Section 94B will not be applicable. If they've borrowed from a bank or notified financial institution, sorry, if they borrowed from a bank or a notified NBFC, then it will not be applicable. Uh, but if they've borrowed not from them, then it will be applicable. Is the lender a PE? If yes, it will not be applicable. If no, it will be applicable. Then interest amount, is it exceeding 1 crore rupees? Yes, only then it will be applicable, because if it's not exceeding, then it will not be applicable. And then if it is applicable, then this is the amount which is provided here, which will be provided as um, a deduction out here, and the other amount will be disallowed. Disallowed amount can be carried forward for 8 assessment years. Maybe going forward you can claim that as a deduction, but in this particular amount it's not going to be provided as a deduction. So that is basically the end of transfer pricing topics, that we have. But we have another topic for today, which is basically advance rulings. Uh, Advance ruling is a topic which is a very small topic, but advance rulings are basically, written opinions. They are authoritative decisions. Maybe there is a transaction that a particular enterprise wants to undertake, like a future transaction, and they want to know about the tax consequences of that kind of transaction in ahead of time. Well, that is where advance rulings come into play. This There was a time that we used to have something called as an authority for advance ruling, but now what we have is something called as bar. Bar is the board for advance rulings. The board of advance rulings is constituted of the members of the income tax department, at least the rank of chief commissioner of income tax and above. Whatever the board of advance ruling pronounces, whatever is the ruling that is actually given by them, it will not be questioned and it will not be invalid just because there was like a vacancy in the constitution of bar. This was the problem that was happening for AAR, for which they changed it to BAR. But now if there is like a vacancy, or if there is a defect in the constitution of bar, whatever is the ruling that they have given will not be questioned and this will not be invalid. Now, these are the applicants, who can actually take, advance ruling under bar. This is obviously a non-resident which has undertaken a transaction, or they're proposing to undertake a particular transaction. Even for, residents, the tax liability of a non-resident arising from a transaction which is proposed to be undertaken or which they're actually undertaking, can be taken. Even for a, a class of persons by the central government, notified by the central government, even a public sector undertaking, they have been notified by the central government, they can also, undertake it. So, uh, if you actually look at it from the perspective of a resident assessee, they cannot really pursue both the remedies. They cannot really have, like an appeal or a revision before income tax authorities, as well as, an application under the bar. They cannot, do both in respect of an issue. They have to choose one. This is just an application fee, the slide that talks about, the application fee. So you can actually look at that, also what is the application fee that will be, provided. What is important is this, which is, the procedure for board for advance ruling. This is where they say that if there is, um, these are the applications where the board will not allow the application. If these are the questions. One, if it is pending before the income tax authorities, something is already pending before the income tax authorities, you cannot take advance ruling for that. If it involves determination of fair market value, then you cannot take it. If it is a particular transaction which has been designed for avoidance of tax, then also you cannot take advance ruling for that. And you have to pronounce advance ruling within a matter of 6 months from the application receipt. So this is what it actually says. Now, this is section 245 TNW, which basically says that if you have taken advance ruling, by fraud or misrepresentation of fact, well, then it's not going to be allowed. It's going to be void, in fact. And this is where they also talk about appeal to the High Court. They basically say that whatever uh, uh, if you're aggrieved by the ruling which is pronounced by the Board of Advance Ruling, then you can appeal to the High Court. But this is within 60 days. And this is where the amended provisions actually came into place. So this is the amended provision. This basically says the order of the bar would not be binding, and either of the aggrieved parties, the taxpayer or the income tax department, the income tax authorities, they have the liberty to actually file the appeal uh, of the bar to the High Court. They can actually go to the High Court for this. These are the questions that I have, provided here. Why don't you take a minute and can you tell me the answer for part A? Do you think they can take, what do you think will be the answer for A? Do you think they have no option? Oh, appeal to the Supreme Court? Nahi. uh, Appeal to the High Court. So yes, for A, they can appeal to the High Court. It's not as if it is binding on the applicant. And what about the second one? The second one is a little tricky, but do you think they can appeal? They can seek Board of Advance Ruling? Uh, okay. No, they cannot. I mean, sorry, yes, they can take, this. So this particular question says it cannot seek the board for advance ruling till the matter is pending. This particular statement is incorrect. They can seek advance ruling in this particular situation, even if the matter is pending before the ITAT. That is because when you actually look at this particular situation, it says a public sector undertaking which has been notified by the central government, even if it is pending before the income tax authority, still they can actually take advance ruling option right here. So in this particular situation, they say that this is an Indian public sector company. So for them, even if the matter is pending before the income tax appellate tribunal, then also they can take advance ruling out here. Yes, it is allowed. Yes, you're absolutely correct. It is allowed. So yes, with this we finish with the revisionary session for today. Just to give you a perspective, this is what we actually covered today. We were discussing how transfer pricing comes into place. This is tax avoidance strategies that were happening. This is the reason they came up with transfer pricing. We discussed these 13 instances under AEs, the meaning of international transaction, deemed international transaction. We discussed the 6 methods for transfer pricing. Then the documentation, remember there is Form 3CEB, TP study, then the 3-tier documentation structure. We discussed safe harbor rules, APAs, primary adjustment, which is basically the transfer pricing adjustment. We say secondary adjustment, which is repatriation, the interest deduction rules. There is a limitation out here. And then we finally discussed something called as advance rulings. And okay, kindly explain safe harbor rules once again. Okay, I'll do that. Okay. This is where we were talking about safe harbor rules. This is coming from section 92 CB. And if you look at safe harbor rules, it says safe harbor are circumstances in which the income tax authorities shall accept the transfer price, due or accrued, deemed to accrue or arise under 911 as the case may be declared by the assessee. In simple words, they basically provide a window for taxpayers wherein, under defined circumstances, the income tax authority shall accept the transfer price which is declared by the taxpayer. Just to explain it to you, let's say that the income tax, that the taxpayer is providing software development services. Now, when they're providing software development services, the taxpayer says that no, a transfer price, a margin of 10% is sufficient. But this is where the tax authorities, they used to always put it into litigation, and they used to say, no, we feel that 25% is, the profit margin. So there was a lot of litigation out here. 10% for the taxpayer, 25% was, just as an example, the tax authorities used to say. This is the reason now they've come up with safe harbor rules. They say they have defined these circumstances. They say that if you're providing software development services, which is provided here, then we feel that the margin of 20% is absolutely sufficient. If the transactions are 500 crore rupees, if the transactions are more than 500 crore, then a profit margin of 22% is sufficient. So what they've done is, for each transaction that is very common, they have identified what is the profit margin that should be acceptable. And if now the taxpayer has a profit margin of 20% or more than 20%, you know that this will be accepted by the tax authorities. It will not be questioned. It will not go into litigation. These are called as safe harbor rules. So what they've tried to do is they've created like a safe harbor out here, that if you transact within this, then this will be accepted by the tax authorities. So those are safe harbor rules. This is coming from Rule 10 TD. You can have a look at that. This is just an excerpt from Rule 10 TD, but these are other transactions for which they have defined safe harbor rules. So these are software development services, ITES, KPO services, etc. This is the link where you can find all these, transactions. Obviously, it's there on the Income Tax Department's website. But, you can actually have a look at this also, this link that I've provided on the chat box. Okay. Any question now? Okay. Any other question? Any other question for today? Okay, if there are no more questions, I think we'll call it an end of the session for today. I will be uploading the slide deck very soon. But thank you so much for your time. I hope I was able to do justice and explain you and help you revise through all the concepts in transfer pricing and advanced ruling for today. Thank you so much, and all the very best for the exam. Thanks a lot. Thank you. Thank you. सर सेशन एंड कर सकते हैं अब. हाँ जी. थैंक. गुड नाइट.